Welcome to our 4-session revision course on F7 financial reporting. My name is Francis Braganza, and it's my privilege to help you to get through this March exam. Now, the big worry, of course, for me, as well as for you, is apart from the 3 big questions that we get, what's going to come up on the MCQs. So because the Section B is going to be 60 marks, I thought I'd start with that today, and then at the end of the session we'll pick up some MCQs. When I see you tomorrow, once we've done consolidations today, I intend to do published accounts and at some stage obviously pick up some MCQs, multiple choice questions. And so the days go on. So if I can take you to the program, you can see there the first day, that's today, this evening, here in London, and different parts of the world, it'll be different times, of course, but a warm welcome to everyone. I can't see anyone's name as yet, but I will look out for any questions you might fire at me, and I'll be delighted to explain and answer back to you. So here we are. The first question I thought I'd do is something called Bycomb, or however you pronounce it. It's the situation where you get a 15-mark, unusual kind of question where nothing balances, nothing needs to balance on consolidations, perhaps. So that's my first concern. There's a nice one in June 2015, which is a decent interval to March 2016, which is the one you're facing on the 8th of March. So I thought I'd do that first, and then once I've got that done, I'm going to take you through a more conventional 30-mark consolidated P&L and SFP. And of course, the bits that are not covered by those 2 questions, I intend to do through MCQs, things like dealing with associates and some of the conceptual matters surrounding consolidations. So that's my plan for this session. We have a 2 3/4 hour session, so I'll give you a 5 or 10 minute break in between, see how we're placed. But I will give you a small break at some stage, and finishing off as close to 8:45 as I can manage. If we overrun by a few minutes, please forgive me. We may be about to balance a balance sheet, for example. So that's the first plan, first thing I'm planning to do. When I see you tomorrow at the same time, I intend to pick up published accounts and standards. As you know, the examination style, Section A, 20 2-mark MCQs. Okay, half of them will be 1 minute long. In your mind, you can do them in a minute, and the other half will be much more detailed. But if you put them all together, the average length of question is 3.6 minutes. So that's something I'll talk about when I'm doing the MCQs. That's Section A. Section B is a 15-marker, usually on interpretation ratios, and then another 15-marker and a 30-marker. Now, the 15 and the 30 can either be on consolidations or published, and obviously if it is on consolidations and published, in the next sitting or in another sitting, it'll be the other way around. So I would suggest that take those 2 areas extremely seriously, because if it's a 15-marker on consolidations, there'll be lots and lots of MCQs to make up the syllabus coverage. And obviously, if it's a 15-marker on published, there'll be loads of MCQs on standards and published type matters. So that's how the examiner is going to balance the book, so to speak. So that's my first concern, consolidations. Tomorrow I'll look at published accounts. At some stage tomorrow I'll do the MCQs, of course, and on the following session, which is the 17th of February, as you can see there, I'll finish off that big published question. It will take a long time to do, and it includes bits of cash flows, and then we're going to be doing MCQs. When I see you after that, on the Thursday following, we have to look at some more MCQs on standards, and obviously MCQs on ratios, interpretation, cash flow, that kind of thing. And then a couple of questions on that part of the syllabus, 15 markers. So this is what I'm hoping to achieve. In between, if you could attempt the revision mock, looking at all those dates, I'll mark them myself and hand them back to you, provided you respect the dates, of course. So there we are. That's the plan of action. Now comes the execution of that plan. If you can think of anything to ask as we're going along, please ask, and I'll keep checking my little message board over here. But most welcome. Let me take you therefore on to the first of our various questions, and this is the first one I had in mind, called Bycomb. And as you can tell from the program, if I just show you the study planner once more, the instructions there that our managers communicated to students is to download the December 14 exam, the June 15 exam, and the December 14 specimen paper, for example, from the ACCA website. So that's what you need to have at your disposal, because you need to be able to write on your question paper in hard copy, because that's what you'll be doing in the exam on the 8th of March. All right, so I hope you've got all that to hand, and I'm going to assume that you have got all that organized, and so my job is to obviously do the questions and show you how to pass, not too concerned about the admin side, except to warn you in advance. All right, so that's the introduction, if you like. What I need to do now is to get into the question. So have a read of the question, please. Perhaps I'll read with you. One good idea before you even begin these questions is to read the requirements. What am I doing here, you see? What question is it? It says calculate the consolidated goodwill at the date of acquisition. Do be careful. Acquisition is not the same as consolidation, so there could be a time lag, a gap. That's 6 marks, so I'm sure that goodwill will be quite searching. And then the question says, prepare extract from Bycomb's consolidated P&L. Obviously that goes to the SFP, doesn't it? CSFP, Consolidated Statement of Financial Position of Balance Sheet, whereas the P&L, of course, is quite a different thing altogether. And then he says revenue, I'll give you 1 mark if you get it right. Cost of sales, being much more demanding with the PUPs and so on, provision for unrealized profit, that's 3 marks. And finance costs and profit in respect of the NCIs, non-controlling interests, that is set to be 2.5 marks, as well as the finance costs. So that's how it's broken up, all very precise, and the markers do give these half marks and things to help people to get to 50%. So our aim is to get some figures down. The only thing I don't like personally about these kind of questions is that it doesn't really balance in the conventional sense. In other words, I'm not doing a balance sheet that balances. I'm not doing a consolidated P&L that adds up at the end. It's just, it's up in the air, and as a student, I'd be concerned, whether I'm close so far from the answer. So my suggestion is go about it doing all your principles, and based on principles and reasonable presentation, you will pass. If you show some skills, some basic skills, you'll get 65% in F7, because the examiners often said to us 65% of the exam is very basic. And obviously if you can do some of the other 35% as well, then you will get a very good mark indeed. In fact, some of our part-timers recently have been getting 80s and late 70s and so on this last December. So the results are very encouraging, but my job is to push you as much as I can to give you as much exposure as possible. So here we are. I've chosen a very awkward question. I hope you don't mind. Something that makes you stop and think. There's no point me doing very easy questions that don't come up. I'd rather do realistic questions. So we're all stretched, including my explanations and thinking about what might come up. So here we are. It says you've got to prepare. It says on the 1st of July 2014. So what sort of year end have we got? It seems to say that date. So I'm going to say the year is 1/4/2014 to 31st of March 2015. And it says on the 1st of July 2014, so that means 9/12 is post-acquisition. 9/12 is post-acquisition, as you can see. And if you acquired 80%, the NCIs obviously are 20%. So that 1st of July is a big deal. And so if I give you a few seconds to read the question, I'll then open up the required account. So I'll leave you free for the next few seconds to read and digest the question. I'll keep quiet while you do that. Okay, when you're ready, I'll take you into the answer page where we're doing all the answers. June 2015. It's about page 10, I believe. And it says at the end of the question, calculate the consolidated goodwill. 6 marks looks like it's going to be quite involved. So I'm going to say A. Calculation of consolidated goodwill at acquisition of the subsidiary called C. See there, Cyclip. It's at acquisition, please be careful. Now, as I'm doing these questions, can I just request one thing from you, please? I don't want to do it at exam speed without saying anything. Obviously, I can get it done in the minutes that the examiner gives you, 27 minutes, if I didn't say a word, if I just wrote fast. I don't want to do it like that. I want to teach as well. So I'm going to do it very slowly, so you're picking up all these principles as we go along. So our precious time together is meaningful. Okay, of course I can do it much faster if I didn't say a word but just wrote. But I don't want to have to prove that to you. I'd rather explain everything. So please allow me a few more minutes on every important point so I can, in case you haven't done much of the tuition, the basic learning, if you can do the revision questions and I explain it adequately, you'll pass easily. This paper is easy to pass. 65% of the paper is basics. Never forget that. It is easy to pass. It has a big syllabus, and lots of people get caught out on some of the MCQs, the peripheral stuff. But it's if you can do the basics, at least 65 marks are guaranteed. And this would rank as quite a basic question, apart from maybe 1 point. All right. So that's your at acquisition goodwill. So I'm going to say that's my page 1. Systematically, like a well-organized student, I'm then going to move into page 2, where I propose to do the next task. Question called Bycomb. And it says, can you prepare the extracts from the consolidated profit and loss for year ended 31st March 2015. Okay, any starter presentation you like, and it says there in B, you've got to do your revenue, your cost of sales. Okay, so I'm going to say revenue and cost of sales. So I'll use those columns that the college uses and gives us the best chance of passing. It then says, can you sort out the finance costs, etc. So I'm going to not commit myself as to where I start my cost of sales. I'll just move on to the third page. And here we're going to have Bycomb. Point B, P&L extracts continued thousands. And here you have your finance costs, interest in other words. Be careful of this finance costs. This kind of point comes up even in our published accounts and of course in our MCQs. So once more, I'm going to be sensible. The question says prepare finance costs and then the NCI. Now, if I say halfway down my page, this is where the NCI begins, and my finance cost slightly overruns, I'm going to look bad in terms of presentation. Okay, so the examiner wants to see whether I'm a professional. The handwriting doesn't have to be perfect as long as it's readable, reasonably readable, but the way you lay it out, that shows you are a good accountant. So I'm going to be sensible and leave a blank page for my items 3 and 4. What else is there? Beyond that, on page 4, I'm going to open up some workings. You've read the question. I've begun to read the question with you. We must now continue reading it. But we've managed to get our group structure sorted. Bycomb workings. And so you have your group structure. Always do a group structure. Whether they give you half a mark for it or not doesn't matter. It gives the impression that you are an organized professional kind of student, professional person. So there you are. B has some shares in C and it's an 80% SAR. And the NCIs obviously must be 20%. But more important than that is the fact that it's a 9/12 post-acquisition situation. So only 9/12 of this year should be consolidated. The first 3 months are pre-acquisition and will affect goodwill. So that's the first thing you've got to do. The second thing you should do is set up your consolidation adjustments. Obviously, I'm going to do a big question once I've got this little one out of the way. But this one's got its own challenges. Because, you know, if the 30 markers on published accounts, the 15 markers bound to be something like this. Okay, and I've chosen this because this is when the pass rate dramatically fell last June. And I think the main reason is people struggle with the consolidation because nothing balanced, you see, in the usual sense. Now, a little bit of exam technique. Why not throw this calculation of investment at cost onto the main goodwill area? Let me just put that in here. Okay, let me take a few extra minutes to write all this out so you have something to take away to look at. Exam technique. Put the investment at cost, etc., directly onto the main answer. So it's easier for the marker, you see. What I'm trying to say is the marking is quite a difficult process. You can imagine with lots of half marks and that kind of thing flying around. So when the markers get the 6 marks that the examiner has given for Goodwill, there'll be little half marks here and 1 mark there and that kind of thing, making up to 6. So my suggestion is wherever possible, if there are things that don't change, yes, they aren't adjustments in the conventional sense, why not put them onto that main page where there's 6 marks for the marker to allocate? If you do little bits on the main page, little bits in the workings, the marker running around might miss half a mark here and there. The supervisor checks it. There's always a highly skilled supervisor checking the markers, but things slip through. You know what auditing is like, for example. Yeah, things do slip through. So I would suggest make the marker and the supervisor's jobs easier by putting as much as possible onto where the 6 marks are going to go. So where it's possible, do it. Okay, you'll see the sense in it as we do the question. All right, so that's my suggestion. We're now flicking back to our first page. Here we are, calculation of consolidation goodwill, 6 marks. So I'm trying to put as much as possible onto this one sheet. Maybe I should be reading the question with you, since we've only just begun to read it together. But you've had a few minutes in between to read it properly. All right, equity shares on the following terms. Good. A share exchange of 2 shares in Bycomb for every 3 shares acquired in Cyclip. So 2 shares in the parent for every 3 shares acquired, double underline the word acquired, in Cyclip. Now if you let your eye come down the page, acknowledging obviously that Bycomb is the parent and Cyclip is the 80% sub, once that's clear in your mind, as you come down the page, he tells you that looking at Cyclip's financial statements, in other words, not the consolidated financial statement, but Cyclip's own individual statement, separate statement, the equity shares of $1 each come to 12,000. So obviously you've bought 80% of that, you see. 9,600. That's really important. And then it says, this is what you've acquired. That word acquired is a big deal, okay? Now, the shares that you've acquired, for every 3 shares acquired, you're giving 2 of your shares. So that's really important. So let's see if I can put something down that makes sense there for you. So let's go back to, where's my question? My answer script, here it is. So I'll start saying investment at cost. Use abbreviations. These questions are very long. If you wanted to write investment, by all means, but you've got to realize that if you put all the full words in, you will not finish the paper. Even if you use abbreviations, it's quite tough. So the abbreviations I use are the ones I've discussed with the examiner. So, and his team of markers. So lots of my friends are markers. So CI means controlling interest. And within that, you have the share exchange. Obviously, 80% of 12,000 equals 9,600 shares acquired in C. And so we're going to divide this by 3 and multiply by 2. And this gives us 6,400 shares in B. B is the parent. Okay, really, really important to grasp that. And each of these shares, let me see where the question tells us a story. A cash payment, okay. And then it says a little bit later on in about the third paragraph, or second main paragraph, at the date of acquisition, shares in Bycomb and Cyclop had a stock market value of $3. Please be careful. Bycomb has $3. And the reason why they give you Cyclop is this is used for NCI. Okay, so that's used for NCI, never forget that. Whenever they give you the $2.50, it's meant for NCI. You know that from basic knowledge. All right, so there we are. Let's go back to our solution. This is an area that students get wrong. My friends who are markers tell me, so I'm going to do this very, very slowly. This must be multiplied by $3. And so if you were to get this little calculation together, you'll see that that comes to 19,200. Okay, really, really important to grasp that. I don't mind saying that 3 or 4 times, how that works out. So let's see if I can go back to my question paper and keep hammering home this point, because it is something that's done very badly by students. So how can I explain it? Throughout the course, certainly throughout these precious few days we've got together, you be the parent and I'll be the subsidiary. Okay, so you have bought 80% of my company. Get that clear in your mind. Okay, you have bought 80% of my company. Now, the story is something like this. You are the parent, I'm the subsidiary, and let's suppose I have many, many, many shares. But for every 3 shares in Cyclip, you see this? C, for every 3 shares in Cyclip, so I've got 3 pieces of paper here, Cyclip, for every 3 shares that you acquire from me, you give me 2 of your shares. So these 2, you see that different color? If you can see, it's a bit more pinkish. So you take my shares. Don't forget what share exchange means. You take away 3 of my shares and give me 2 of your shares. What lots of students do is they think the parent takes away 3 of the subsidiary shares and gives 2 back, which is nonsense. It's a serious misunderstanding. So if you take away 3 of my shares and give me 2 of yours, the shares I now have are actually in your company. And because the share values are slightly different, there are fewer of your shares that you have to part with compared to the number of shares you've taken over from me. Okay, I don't know how many times that's come up. 25 times maybe in my experience. 25 exams, maybe 30 exams. It's that frequent. And it comes up almost every time. Will it come up this time? You judge. There it is in this particular exam anyway, the one we're doing. Okay, so that's the basic message. Let's get back to our question paper. What else is there for us to sort out? The share exchange, that's fine, so we can give that a bit of a tick. The next one I must do very slowly. A cash payment due on the 30th of June 2015. Hold on. Is that 1 year later, is it? 1 year after acquisition, what's known as deferred consideration, postponed. Maybe you don't have enough shares to give me. You don't have any cash to give me. I want some cash. I don't want just pieces of paper called shares. As the subsidiary owner of 80% of the subsidiary, which I've given up to you, I'd like to have not just shares, I'd like some cash, please. And then you're saying to me, the parent saying to the subsidiary, sorry, you don't have any cash now, but can I promise you some cash in the future? And so because it's in the future, you have to discount it. So two things you have to work out. One is how much cash, and secondly, of course, how to discount it. Okay, and then there's one other little problem I'll show you in due course. And so it says, you're going to give me $1.50 per share acquired. And the number of shares acquired, of course, the number of shares acquired is naturally 9,600. In other words, the shares that you have acquired in my company. Okay, that's what we mean by acquired. And the cost of capital is 10% per annum. So that's where we have to get involved in a little bit of discounting. Let me show you how that works. Again, that's something that's come up repeatedly, even through published accounts and other areas. So take that seriously. Let's press on, therefore. The next little challenge for our 6 marks, we have something called deferred consideration. Deferred, postponed consideration. Many students find this very difficult. I don't know why, it's just a bit of common sense, to tell you the truth. So let's say there's 9,000, or shall we say, let's remove the equals to sign. Let's put down the 9,600 first. Acquired. These are the shares acquired. And you're giving $1.54. Great care with calculator errors, be careful. 154. So tapping that into a calculator, I find that's 14,784, some awful number, but with a calculator, no problem. And then I'm going to multiply that thing by 1 divided by 1 plus the discount factor, which is 10%. Okay, and if it's 1 year away, you just do it like that. So you multiply or to the power of 1 year. Sometimes it's 2 years, but when it's 2 years, the examiner usually gives you, he does give you the discount factor. Obviously, if you tap that into a calculator, if you've got a clever calculator to do it for you, 0.9091. And so if you multiply like this, the answer that arrives here is a present value of 13,440. 13,440. And why are we doing all this funny stuff here with discounting? So I'll write here the word discounting. Because it's in the future, you see. And the trouble with discounting is when you discount, in other words, if you offer me 14,784 in a year's time from the date of acquisition, to me it seems it's very far away. And because of the risk involved, it's far away. You know, you may not make that offer again. You might go into liquidation. You know, had you given me the money now, I could have put it into the bank and earned interest. All that kind of thing. So because of the little question mark surrounding the future payment, what we've got to do is that future payment we need to discount. Okay, so that's the way to think of it. The 14,784 is in the future, 1 year in the future, a much bigger figure, and you discount it to a small figure. Okay, so the big figure comes down to 13,440. 14 whatever comes down to 13 something. Discounting. Now the only trouble is when the year is up, you'll have to pay me not 13,440, you'd have to pay me 14,000, the full figure, 784. So whenever a student does discounting, you must do unwinding. Discount, unwind. Discount, unwind. Don't forget, discount, unwind. Okay. So the unwinding takes it back up to the big figure. Never forget that. All right. Let's see if I can just write here. Also important is what's known as unwinding, i.e. adding back the interest or finance cost. In other words, putting it back to what the original figure was. Okay, unwinding. And what you do there, quite simply, is you take your 10% and you multiply by 13,440. And of course, for just 9 months. Because by the end of the year, there's only 9 months of the 12 that have elapsed, because the acquisition was 3 months after the year began. Okay, I'll just make sure you understand that point. It says there, 1st of July 2014, so you're counting from the previous year end, March 2014, April, May, June have passed, and then you acquired the subsidiary. Okay, so what we're saying is you must allow for the fact that only 9 months is to be charged to the P&L, as we will see. So where are we? Let's see if we can continue to do this. So I'll go through that again. The future figure is 14,000 and something. It's down to 13. But when the time comes to paying for it, you've got to pay me not just the 13,440, the 13,440 plus 10%. It's like reversing the discount factor. All right, so there we are. That's the end of that. And then the last bit of the question is where you bring into play the NCI, non-controlling interest, which is of course 20% multiplied by the 12,000 shares. Obviously, if you acquired 80%, the NCIs must have acquired 20%, and this is to be multiplied by the famous $2.50 near the top of the question. Have a look. It says so in about the fifth line or so of the question. Let me show you this. Yes, there we are, the NCI, that figure there, $2.50 per share. Okay, so lots of little bits and pieces. You can see why this is 6 marks. You can't have a sort of general idea and pass. It requires extreme care. Yet each part of it is easy. I've done 3 parts with you. One is the share for share exchange. The other is the discounting and the need to unwind, as they say. And then the third part is the NCI alone. And if you were to add that up, I'll tell you that the figure comes to 38,640, I believe, yes. That's for the whole company. And then we just take away from that, once we've done our workings, the net assets at fair value at acquisition, which obviously comes from a big working somewhere. And once I've brought that into play, this figure here becomes the goodwill at acquisition. Six marks for that figure. And we've done the bulk of it, believe it or not. We've probably got about 3.5, 4 possibly, out of 6, just by doing the 38,640, 3 little parts to it, particularly the MCI. The NCI is easy. All right, let me put that aside. It seems like a good moment for us to go back and sort out some of these adjustments, these traditional adjustments. So you see, I'm doing the question very slowly, and if you haven't done the main course or you can't remember how it's it's put together, I'm trying to build some basics into your skill set during these precious 10 hours or so we have together. All right, so that's your cash payment, done that. NCI, yep, no problem. And then you have your revenue, cost of sales, all that kind of thing. The only thing to look out for here is it's a 9/12 post-acquisition. So when you're doing your revenue for the subsidiary, you must only bring in 9/12 because you can only consolidate for that part of the year where I'm under your control. Okay, you can't consolidate the pre-acquisition 3 months. So that's important. Sorry, Fatih and Susie, welcome. I'll take one question at a time. Thank you so much for the questions. I love questions. Okay, first question, can you elaborate the share exchange? Right, I am at your service. So let's see if I can explain the share exchange. All that we are saying is that if you acquire 9,600 of my shares, for every 3 shares of mine, maybe I'll hold these pieces of paper up for you again if it just helps me to explain a bit. If you acquire 3 of my shares, if you take away, for every 3 that you take away from me, you've got those, you're giving me 2 of yours. Okay, so that's what the share exchange is. Really easy. And obviously that gives you 6,400 shares, and each of the shares in your company are worth $3. That's it. That's how I can elaborate it. I hope that makes sense. Susie, do they give you the discount tables? I have to say that the examiner is very fair. He doesn't give you discount tables in terms of many, many pages like some of your excuse me, more mathematical exams. For us, he tends to give us a little, a couple of small, a little extract. Or if it's 1 year, he expects you to do what I just did there. In other words, if it's 1 year, you've got to work this out. Yes, this sort of thing out yourself. If it's 2 years, then he gives you the table. It's a small little extract from the table. So that's the answer. Okay. He'll never expect you to do 5 years and, use a clever piece of maths. This is not a maths paper. If it's 1 year, he expects you to do it by taking 1 divided by 1 point, whatever the percentage is. But if it's more than 1 year, he will give you the table. So those are the 2 questions I was asked. Okay, let's press on, make sure we get this question actually done. The net assets at fair value. I was just reading the question, but thanks so much for your questions. Let's see if I can press on a bit. 9/12, don't forget. The one thing that's troubling me a little bit here is this finance costs, because this is where the unwinding's got to go. Okay, so be careful. In due course, I'm going to change those numbers slightly, add something to it. What else? The story downstairs, retained earnings, okay, 13,500, and that's at the start of the year. Okay, and this is of course for the year. Does everyone agree that the 13,500 is on the first day of the year, but you can't take all of the 2,400 in, you've got to take a proportion of it, okay, in due course. So that's something that we're going to have to look at in some detail in a few minutes. Let's read on in case there are any adjustments. The following information is also relevant. At the date of acquisition, the fair value of the subsidiary, their assets, my assets, were equal to the carrying amounts, with the exception of an item of plant which had a fair value of 720 above its carrying value. The remaining life, underlined remaining, is 18 months only. Quite short, isn't it? And sounds like 9 months of those 18 months have expired this year. So as you do your calculation, you've got to be sensitive to that. And where does all this end up? Cost of sales. So it's packed with information. My suggestion is to read it lightly the first time, and second time you read it, take it, really, really seriously. So just a little technique. So that's my first page. Second page, P&L, not ready for that. Finance cost, not quite. Excuse me, consolidation adjustments. This is where we left it a few minutes ago. We're now going to say, as per question, point 1, fair value adjustment, 720 to C, cyclip the sub. And of course, you've got to divide by 18 months. But the trouble is 9 months is used up post-tax. So I suppose, in a sense, you're taking half of the 720, are you not? So 360 becomes the post-acquisition depreciation adjustment. Naturally, the fair value adjustment at acquisition, that affects goodwill. Because it's at acquisition, this affects goodwill. But because this is post-acquisition, it cannot affect goodwill. All right. Cannot affect goodwill. All right, so lots of little things. That will be in the exam. It's always been, or as good as 100%, nearly 100% guarantee I can give you. Now, this is the only, I was saying to you, this question is pretty easy, but every now and then the examiner just throws in a nasty little point. Otherwise, everyone's getting 15 out of 15, or so he thinks anyway. So just to keep those very good students a bit more humble, the examiner gives us some horrible little half mark to deal with, or maybe 1 mark sometimes. So we don't need that to pass, but let's face it. Let's try to face it, okay? All of us have to stop and think about these little points. So the first point, sort of under control. On the 1st of April 2014, hold on, is that 3 months before acquisition? April, May, June. So this is 3/12, 3 months before acquisition. Or shall we say that's at the start of the year? Maybe easier for me to say that. At start of the year, it looks like. Yep, it is. Subsidiary commenced the construction of a new production facility, financing this by a bank loan. It's okay? He's trying to weave in some accounting standards. There's so many standards, 25 standards in our syllabus. The examiner's struggling to cover them. Yes, so what he does, he brings in little awkward little points from various standards. So this is IAS 23. Cyclops has followed the local generally accepted accounting principles in the country where it operates, which is true, which says you cannot capitalize interest. Bycomb, the parent, has calculated that in accordance with the IAS, borrowing costs, interest of 100,000, which accrued evenly throughout the year, I see, would have been capitalized at that date. Okay, had they followed the IAS. So let's get this straight in your mind. The subsidiary me is following my local accounting standards, which say that if I borrow money to put up a building or whatever, I cannot capitalize interest. I must write it off to the P&L. So what have I done? I've written it off to the P&L. How much have I written off? 100,000. Where is that? It's in my finance costs, in my separate individual P&L account. Okay, now when we come together, even though it's not compulsory, the ideal is that we must have uniform accounting policies. So the parent's policy dominates. So the parent says to the subsidiary, hey, you've got to follow my accounting policies. Okay, ideally that's what happens. It doesn't always happen, so it's not a rule, it's not compulsory, but it's the ideal. There's a slight difference there. So anyway, this company, the subsidiary, has agreed with the parent, and so the parent is saying, you've written off 100,000 to your P&L, but you don't have to write it off. Don't write it off, add it back to profit, and capitalize it like a non-current asset. Okay, and as you can see, the production facility is still under construction. That means there's no need for depreciation. So many principles for us to deal with. Okay, so here we say, therefore, no depreciation needed on the 100,000. The cleverest point of all is realizing that this 300,000, the 300 has to be reduced, okay? Reduce this by 100,000, since it must be capitalized That means treated as a non-current asset. Must be capitalized. Okay, so what's left, I suppose, is 200. So that's a clever point, isn't it? Therefore, 200 left, and 9/12 of that is post-acquisition. That is one clever point. Okay, so I'll just run through that again. It is one of those things where if you're good at the standards, then you'll get it just like that. But if you haven't covered the standards, my job is to cover little bits and pieces during this little revision course we have. So what's happening here is in my P&L, I'm the subsidiary, I've written off 100 as part of my 300. But you're saying, no, that 100 don't write off, add it back to profit and treat it like a non-current asset. So it's not written off to profit, and the other 200, obviously 9 months of that is consolidated. So it looks terrible, but actually it's not that bad once you get into it. So I better write something down as we tackle our solution. Here we are. Point 2, the finance cost. In C, Cyclip the subsidiary. 9/12 of 200, 150 is post-acquisition. In other words, this started life as 300 less 100 not to be written off anymore once our policies come into line. Okay, so that 150 goes to the consolidated P&L, CS, profit and loss, as we will see. All right, so clever stuff that. We'll think about it again when we put it into place. So point 2, let's go have a look. Point 3. Next, point 2, sort of under control. It is a tricky point though. Point 3, sales from Bycomb to who sold? Parent sold. If parent sells, NCI not involved. In the post-acquisition period are 3 million, markup on cost of 20%, and 420 of these goods are in inventory. So what you do is you multiply by 20 over 120. And so the PUP is 70. Let me write that a bit more neatly so you can read it. So sorry. Excuse me. Point number 3, where we've got the PUP. 3 steps. Step 1, who sold? Parent sold. Therefore, the NCI is unaffected, does not suffer. Naturally, if the subsidiary sells, the NCI does suffer. So we then get busy with our number crunching. 20 over 120 multiplied by 420 equals 70. That's the PUP, and that goes to the consolidated profit and loss, statement profit and loss. Don't forget, this is post-acquisition. You'll never get pre-acquisition PUP. And don't forget that this little figure here is a bit that's in stock, unrealized, in inventory. And naturally, the 3 million is intercompany sales. Also, 3 million is intercompany sales purchases. So that's going to be cancelled in due course. So that's your very standard kind of question, kind of point, point number 3. So I'm going to confidently tick that off. It comes up in the next question as well. Bycomb's policy is to value non-controlling interests at fair value. For this purpose, use the $3 share. What figure was that? 250? Was it 250? 250. 250. So use 250. So I'm going to tick that off. So I'm going to use 250 in due course. In fact, what I better put a little cross besides that, because we need to come back and think about that. Though we've sort of half done it in the Goodwill anyway. So there we are. And then it says at the end of the year, excuse me, the parent carried out an impairment review, and it says that there's an impairment of 500,000. Very important to understand, oh, by the way, impairment goes to cost of sale. Very important to understand that the impairment can only be for the post-acquisition part of the year. There's no such thing as pre-acquisition impairment. Lots of my friends who are markers say that's one of the most common ways people lose a mark in the exam, or half a mark. They lose something. Okay, so if the year begins there and ends there, and you acquire me 3 months after the year began, impairment can only be for the 9 months after acquisition. You can't have impairment before acquisition. Okay, so it's automatically post-ac. So I'll just say always, excuse me, post-acquisition. All right, sorry about this. Always post-acquisition. Otherwise, I don't think there's anything else to stop us finishing off the question. So we've done our part. All we have to do is our little net assets list, and then we'll eat up the main part of the question, the goodwill and little bits of the P&L that are required of us. Really, really straightforward question once you get past the finance cost and all that kind of thing. All right, so let's go back here, have all this to hand, but more importantly, let's keep this in your mind's eye. I'm now moving on to page 5, I suppose. The next page anyway, whatever page number it is for you. And here we have Bycomb. Excuse me. And workings. Workings continued. Thousands. The CSFB is not needed. So we can just say net assets at fair value at acquisition of the sub called C. Okay, and there's no need for the CSFB column because it's not needed. Not in this question, obviously it'll be in the next question. All right, so what can we do at acquisition? The share capital of the subsidiary, also known as ordinary share capital, is a straightforward 12,000. Have we said thousands upstairs? Looks a bit more professional if we do. 12,000. Where from? Let me point out every figure. Here we are. You see this figure here? 12,000. That's where it comes from. So, 12,000 is in place, and then you've got your retained earnings. At the start of the year, a little bit to the left, is 13,500. Where from? Let's go have a look. At the start, oh, here it is, look at this, 13,500. And so I go back, armed with that, and then I've got to add to this for this year. The figure is profit after tax of 2,400. Where from? This figure here, 2,400. The trouble is, excuse me, the 2,400 is the profit after charging 300 of finance costs. How much should we charge? 200. What do? I add back 100. That's it. So I'm going to bring in the adjustment plus the interest, i.e. finance cost, F cost, not capitalized. I beg your pardon, not written off but capitalized, is what I'm trying to say. Not written off but capitalized as a non-current asset in the balance sheet. And that figure, of course, is 100. So it looks like the figure that we have here is 2,500, not 2,400. And it is that figure that I've got to take 3/12 of. Not 6, obviously. 3/12 is what I'm trying to say. 3/12 of that, which is obviously 625. So all of this comes to 625. So you've got 13,500 at the start, and for this year, just 3/12 of the year after adjustment. And so once you add that up, you find yourself with 13,500 plus 625. So 13,500 plus 625, if I can just demonstrate with little brackets, 14,125. So that 14,125 can be added to the share capital value upstairs of 12,000. Okay, so it looks like that finance cost is having lots and lots of little implications that we must cope with. Then, of course, the fair value adjustment to the asset, whatever asset that was, doesn't really say plant. Yeah, it does say plant, so I'm going to bring in 720. And that's the amount that you have to consider, because it says something about the extra value. So I'll just go through that once more. If I can just take you back to the adjustments. The 720 affects goodwill, but the depreciation, which happens to be as much as 360, that doesn't affect goodwill because, of course, that's post-acquisition. So that's the name of the game. Be careful. All right, so 12,000 plus 14,125 plus 720 is 26,845. So I suppose I've been teaching this subject for more than 25 years, and recently, of course, we've had more than one paper per year. So I suppose I've seen this examiner and previous examiners examine this point that I've just pointed out, just done with you, something like 50 times, 55 times, 53 times, whatever it is. So without a break, okay? So there's a very good chance it might come up for you. So this goes into goodwill. So that is virtually guaranteed to come up. I've never not seen it in the exam, this net assets list business. Okay, so there you are. Sounds like the share capital is lovely. The at the start figure is no problem. The profit after tax usually is quite easy. You just take 3/12 of it. So this is the pre-acquisition part of the year, okay? Pre-acquisition, 3 months. And what makes this question a little bit more difficult is the messing about with 100. You just have to be careful and hang in there. Now, I'd like you to help me to finish off the goodwill. Can you pop that 26,845 onto your first page, please, and work out the goodwill? What is the goodwill, do you reckon? Let's see if I can catch up with you. Where's my goodwill page? Here it is. So let's bring into play here 26,845, and therefore the goodwill is 11,795. 6 marks. I think every one of those marks we fought hard for. Okay, we picked up a couple of additional marks as well for other things, but that's certainly something we can easily grasp. All right, so we'll practice that technique again a little later on during this session. I'm more concerned on getting this thing done. We've got a couple of other challenges ahead of us. Things like the P&L account, or at least parts of the P&L. So let's go back to our requirements, and you can see there, maybe I'll just turn it up on the screen, extracts from the consolidated P&L, as you can see there, for revenue and cost of sales and so on. So different ways people do the P&L. Here's the way our college does it. The consolidated P&L, let's have group somewhere here. Let's have our consolidation adjustments about there. Let's have our subsidiary C there and our parent B there. So this is the parent Bycomb, subsidiary C, and it's an 80% job, and it's 9 months post, 3 months pre, of course. And have we said thousands upstairs? Let's do so to make it look a bit more professional. At the top of every page, you must put down either the name of the question or the question number. Okay, so something's got to identify it. Okay, now let's start picking up some cheap marks. The revenue from the question for the parent, clearly 24,200. As far as the subsidiary is concerned, obviously you'll take 9/12 of 10,800, 9/12 of that thing. Okay, and then you do your intercompany sale. And we're doing the cost of sales, much the same sort of thing. So you keep your question paper handy while I pull out the numbers. Right, revenue said to be 24,200. Easy enough to do. And as far as the subsidiary is concerned, you take your 10,800 and of course you take 9/12 of that, which is naturally 8,100. So just showing you little workings to the examiner. 8,100. The intercompany sale, if you remember, was 3 million or 3,000. And so if you extend left to right, you've got 29,300. Okay, and that's your answer to 1. So let's be clear about this. Okay, examiner, you wanted me to give you your answer to B, little 1. Okay, now let's leave a couple of lines so it's easier for the marker to follow what we're doing. We're then bringing in our cost of sales, promised 3 marks. So this looks like something a bit more involved. The parent, of course, is a straightforward 17,800. The subsidiary is 6,800, but multiplied by 9/12, which obviously is 5,100, which figure I'm going to put in here, 5,100. And so the intercompany sale, 3,000. These must always be the same, by the way, the 3 and the 3. Okay, so don't forget those are always the same. I'll just write in class, just between you and me, don't have to do that in the exam. Just remember to do in your head that it should be the same figure. Because if you sell to me, I buy at the same price. Before we pass away from the cost of sales, we've obviously got to bring into play things like the PUP, provision for unrealized profit, which was, I believe, working 3. And that figure, the parent sold, you see. And if the parent sells, the PUP goes to the parent's column. If the subsidiary sells, it goes to the subsidiaries column. And then there's some depreciation, and that was the subsidiaries depreciation, subsidiaries asset, and that we got through our working 1, which was, you remember, 360. Subsidiaries asset means subsidiaries column. Whoever's asset, that column. Whoever did Yes, whoever's asset is depreciated, that column. And then, of course, you've got your goodwill impairment. And that always goes to the subsidiaries column. And that was question. As per question, I'll just move that down a bit. As per question, that was point number 5. Okay, and that is 500. Put that into the subsidiaries column because obviously the NCI must suffer some of that. So there's your cost of sales. You can see why that's 3 marks. Lots of half marks, the odd 1 mark going into that. So 17.8 in brackets, as is the 5.1. The 3,000 is obviously the cost of sales of the subsidiary being cancelled because the parent sold to the subsidiary. The PUP is 70, whoever sold that column. Depreciation is 360, whoever's asset that column. And goodwill impairment always goes to the subsidiaries column. Excuse me. And so what we can do is grab hold of all of this. So sorry, in a huge big bracket. Which we're going to add from left to right. Give me that figure, please. What do you reckon that figure is? Put it on screen. I'll give you a challenge. How much you reckon? All the figures from left to right. Brackets means deducted. No brackets means added. Whichever way you want to think of that. What's the grand total, please? How much? I'm looking it up on the message board. So I'll do it for you. 20,830. And that indeed is the answer to B2. Answer to B2. Very straightforward indeed. Well done, Susie. Very fast. It takes a few seconds for it to come through to me here, so you must have been doing it the same speed as I was doing it. Well done. All right, so that's the end of that part of the question. We've got one more challenge for the, actually a couple more, finance costs and profit or loss for the NCI. So quite, yeah, a little bit still to go, so maybe we should just move on, pick that up. We've got it all set up here. And if you want to keep that same column, those columns going, you can start another page perhaps. BC, adjustments, and group. To speed things up a bit. Thousands, okay. Just little extracts, you see. So as per question for the parent, looks like the finance costs are 400. So let's pop that in, you see. For the subsidiary, I reckon it is 9/12 of 200 following our working 2. And so that's 150. So put that into the excuse me, the subsidiaries column. So this is the sub, this is the parent. The sub obviously is 9/12. So don't take 12/12, only 9/12. And then of course you've got the famous unwinding. As far as the unwinding is concerned, the present value after discounting was 13,440. If I just take you back to your goodwill. I take you back to your goodwill. A few minutes ago, we had 13,440, and obviously 10% of that is this unwinding thing. So 10% of that multiplied obviously by 9/12, because that takes you to the end of the year, to end of the financial year. And so the answer there, 1008. So all of this stuff comes to 1008 because that's a cost. So it's all going to be deducted anyway. So once I've got that organized, I can then move from left to right, add it all up, and the figure there that the examiner had, 1558. 1558. And this is his answer to B3, requirement B3. Okay, that's the total finance costs. Okay, so we're using the same traditional method with columns, just doing little pieces of it. It's not as satisfactory as doing a big question, which we will do in case it's a 30 marker. But in the exam, you just have to believe that your principles are enough to get you through. The reason why the unwinding is charged, of course, is that it's the amount that the parent owes the subsidiary. And so the parent must charge its P&L. It's like interest on the outstanding amount that was discounted. And so finally, point number 4, the profit for the year attributable to the non-controlling interests. Now, where we're not doing a full P&L, we have to be extremely careful to get the right bits and pieces into place. Obviously, take direct from the question the profit after tax. If I just show you the question once more, towards the end of the P&L of the subsidiary, it's 2,400. That obviously needs to be adjusted slightly. So I'll start with 2,400 profit after tax. And that is before consolidation adjustment. And so what I need to do is to add the interest that's been treated as an asset, capitalized, i.e. not written off. You can't do both. So it's not written off, it's added back to profit, and so the profit becomes 2,500 as we had somewhere a few minutes ago. And of course, if you start taking all of this, how much of that should go to your consolidated P&L? And that's the big question. If you remember, 3/12 went into the pre-acquisition. So I suppose if I multiply by 9/12, the figure there will be 1875 for the whole of the sub-company. Okay, so 9/12 is not 75% or anything. It is the whole of the company, but for the correct portion of the year. Okay, so this is the post-acquisition only part. And then, of course, you've got your impairment of goodwill. And that's 5 of the question, 500 comes off. Post-acquisition depreciation, as we had earlier, working 1, I think it was, 360. And so if you were to deduct like that, the figure that we must attack is 1015. And if you take 20% thereof, the NCI becomes, whatever that is, 203 is what the examiner had. So that's the answer. And that's to B, item number 4. Okay, so there you are. Quite a serious question. I decided let's do something a bit advanced. because the easy baby questions don't come up, except maybe will come up in MCQs, but the serious questions we've got to be able to do. So there you are, from June last year. That's so about 9 months ago we had that very question. So that's all I'll say about the question. By all means, look up the examiner's feedback on that, see what you can make of that particular exercise in terms of additional knowledge. All right, otherwise I'd like to move on, keep tight with our time. If I can just go back to our study planner. Bycomb, not too bad. The huge one I need to do, of course, is plastic. But on the right, you have there some homework exercises I suggest from the revision kit, as well as the particular exams I've recommended, like the specimen paper. Lovely question called Pyramid. Pyramid is a little bit like Bycomb, except it's more to do with the balance sheet, the CSFP, rather than the P&L like Bycomb had. But I'm concentrating on plastic. At some stage during the next hour and a bit, I've got to give you a break for a few minutes while you recuperate for 5 minutes, and then we come back and finish off plastic. If we can start some of the MCQs today, that's great. If not, first thing next time we'll do them. I'm only going to see you tomorrow anyway, so it's quite soon, happy to say. All right, have a read of the question. It is December 2014. So where is that? Let's see if I can find it. December 2014, page 12, I believe. So give that a quick read, please, if I give you a couple of minutes head start. As you read it, underline a few points here and there. So where are we? Let's come together. At least 6 or 7 page long answer, much more serious than the previous one. I'm sorry, the percentage is still 80%. It's not always 80%, could be anything. And the year ended there is said to be 1st of October 2013 to September 2014. Some people like to do timelines. If you think that helps, please go ahead. Okay, so here we have it. And that looks to be, if you count from 1st of October 2013, I'm going to say 3/12 pre and 9/12 post. Again, it could be anything in the exam. It could be 2 and 10, for example. Of the equity share capital of subtract, the subtract looks to be the subsidiary. And so that's good enough to make me say that this is the parent and this is the 80% sub, and it's for 9/12 of the year, whatever each question says. I'm sorry, both questions are 9/12, but please excuse that. This one had so many lovely points in it, I wanted to do it to show you how to handle it. Okay, you've read the question earlier, so my task is to open up the required accounts. So let's move into our workings page. Where we're going to set up plastic. which is from December 2014. And part A says, consolidated, what does it say? Statement of profit, loss and other comprehensive income. So abbreviation, statement of profit and loss and other comprehensive income, or SPLOCI, saves a little bit of time. Perfectly allowed in the exam, where time is the most precious thing of all. So little abbreviations are allowed by my examiner. I've chatted to him many times about it. Okay, so in due course we're going to have to do a big group structure, but if you'll allow me the liberty of saying this is group, just picking up the momentum from the previous question, consolidation adjustments. Then we have the subsidiary, excuse me, we have the parent. This is an 80% sub, and that's 9/12 post-acquisition. Okay, and as always, we have all our good friends like revenue, cost of sales, etc. So there's a nice connection between what we were doing 20 minutes ago, the previous question. That's my first page. The second page, believe it or not, is where the examiner says to us, okay, I want you now to open up that's the first page. I'd like you to open up an SFP. So this is my second page, plastic. Consolidated statement of financial position as at September 2014. And you have all your non-current assets and all that kind of thing. So in due course, no doubt, we'll come in and fill up a little balance sheet after the break. Let's get to the break first, having conquered the difficult parts of this question. All right, not difficult, just, challenging, let's put it that way. So if that's your second page, page 3 says, or in part C it says, can you do some discussion, another subsidiary called dilemma. So I better not forget that. So there is a page 3. Dilemma. Dilemmas, assets. A couple of little trick points he's trying to challenge us with. So it's not many marks, 3 marks, but let's keep a page aside so it forces us to do something. If I don't keep that page aside, it's quite likely, if I'm being fast on the exam, like, typical student, I might actually miss the point altogether, lose 3 marks. Maybe by saying there's a whole blank page, it forces me to come back and fill it up as a student. All right, so here's your workings. Let's say it's all thousands. And as always, we start with the group structure. Anything more than 50% is a subsidiary. If it's between 20 and 50, of course, it's an associate. Remember that? So P has some shares in S, subtract, or someone, 80% sub. And so the NCI must be whatever's left out of 100%. And as it happens in this particular question, 9/12 is post-stack, or 8/12 or whatever, 6/12 the examiner says. That's the first concern. The next concern, of course, is the famous consolidation adjustments. I think we've said thousands upstairs, so that's fine. And so we go back to the question. You had a chance earlier to read it. I'm now just confirming a few things, I hope. So the first paragraph tends to be a little bit unfriendly, but you've just got to hang in there and do something with it. Don't give up. Sorry, Susie, I didn't even see your question. My apologies. I was so concentrating on this. Yeah, the consideration was satisfied by a share exchange of 2 shares. Here we go again. 2 shares in Plastik for every 3 shares acquired in Subtract. It could be, 4 for 2, or 5 for 6, or whatever. But here it says 2 shares in Plastik for every 3 shares acquired in Subtract. At the date of acquisition, shares in Plastik had a market value. Here we go. You can see it's the same examiner. So many similarities between those 2 questions. Plastik will also pay cash consideration of something cents on such and such date, 1 year away, 1 year later, for each acquired share. Cost of capital, here we go. And none of the consideration has been recorded. Is that a way of saying, therefore you do so? Therefore we must do so. The examiner wouldn't tell you to do so, but it's a subtle way of saying it hasn't been done, therefore you must do it. All right, so now we must unpack that chunk of marks. There's a gift of marks sitting in there. We've got to unpack the whole thing. It's a little bit more searching than the previous question, I suppose you could say. So, it is a 30 mark after all. Expect it to be a bit more searching. Consolidation adjustments, we've said thousands upstairs. The very first paragraph of the question says consideration needs to be recorded. So that's what we're trying to do. First things first, share exchange. The amount acquired, 80% of 9,000 shares, 7,200 shares in the company called S, the subsidiary. So I suppose we're dividing by 3 and multiplying by 2, and that gives us 4,800. And these are shares in P. And each of these shares apparently worth $3, making the figure 14,400. Now, because we're doing a balance sheet, I can't do it like I did on the previous question, just relax. Don't have to do a balance sheet in SFP. Here, of course, I've got to split it between the ordinary share capital, OSC, which is 4,800, and these are $1 shares, it says. And the other one is therefore 9,600, which goes to the share premium account. How come? It's at the rate of $2, meaning obviously $3 minus $1 share capital gives me $2. Okay, so this is just information. The figure's already there, 9,600. So let's see if I can explain that again, the share for share exchange. Someone asked me earlier, can you do the share exchange for the previous question? So let's see if I can do it again here in a way that you will remember it. So if I just make myself get bigger on the screen, I'm the little subsidiary and I've got lots of these shares, but for every 3 shares, see, for every 3 shares that you acquire, you're the parent, remember, you acquire from me, you give me 2 of your shares. So for every 3 shares, you give me 2 of your shares, or whatever the examiner says. And if you give me 2 of your shares, the 9,600 share premium and all that kind of thing must be recorded in the parent's books, not the subsidiary. That'd be wrong. Okay, so that's that. What else do we have in this lovely detailed question? Almost inevitably, we have some deferred consideration. So by now, these things are getting a little bit more familiar. Deferred consideration. It says there, if you're looking at the first paragraph, the amount of shares acquired, so the acquired shares is 7,200. What is that 7,200? It is this one, you see, from up here. This 7,200 shares. So you start the process again. How many shares did you acquire? Acquired. What lots of students do is they take the 9,000 in because they forget that you can't, give them cash to the NCIs. I mean, they've still got their shares. So they tend to do it for the whole company. Please be careful. This is only for the shares acquired. And apparently you're giving, it seems, where's that figure? 27 cents or something. So you've got to be careful with the zeros. 0.275, which is, I believe, 1980. And that is the cash in 1 year's time. So where goodwill is not part of the main answer, like in the previous question, just do this bit as part of your workings, as a little helps you to relax a bit. Okay, if you start with your 1980, you then multiply by 1 divided by 1.10, i.e. 0.9091, and so the answer becomes, I believe, 1,800 present value. And needless to say, though I will say, that the difference between these two is, of course, the unwinding. 10% of 1,800 is 180 interest, which is 10% of the present value. Don't forget, it's not 10% of the 1980. And this interest you multiply by 9/12, or 8/12, or 6/12, whatever the post-acquisition number of months is, and that's charged in the consolidated statement of profit and loss as finance costs. All right, so you can see if you do enough of these questions, a bit of homework, lots and lots of this sort of thing is going to become second nature. Really, really straightforward. All right, that's the end of the first paragraph, more or less. Let me just go back and check, make sure I haven't missed anything. Where's that question? Okay, the first paragraph's sort of under control. The familiar share-for-share exchange, the cash, discounting, unwinding, all that kind of thing. Don't forget a bit of unwinding as well. We then have our revenue, cost of sales, all the usual. Nothing much to report. We're a bit suspicious about our friend finance costs because there's going to be some unwinding to go on to that. At the end of the year, the profit after tax for the year is 2,000. So this is your PAT, profit after tax. Would you agree that 2,000 must be part of the figure down here? It must be part of this. Okay, so the 2,000 is part of this. The 2,000 is in the 3,000 year-end figure because the balance sheet is a running total, whereas the P&L is for 12 months at a time. Never forget that kind of thing. So gradually we'll have to do some time allocation, that kind of thing. The reason why this question is harder than the previous is because here we have to do a proper CSFP, a balance sheet that balances as well as the big P&L. So it's very much a grown-up question. Okay, what else can I say? Interesting that the question says for the parent, there is some other comprehensive income, also known as OCI. Other comprehensive income, gain on revaluation of property to do with the parent. And later, note 1, they explain how all this works. So clearly, if that's 1,500, it must be sitting in here. Okay, so reflected already in this 18,700. It's already at fair value. I'm sure that's what point 1 will say in due course. In fact, why don't we read point 1 to put your mind at ease? On the second page, at the date of acquisition, the fair value of subtracts assets and liabilities were equal to the fair value except for a little fair value adjustment. And so it goes on. And then it says, subtract hasn't done what we are about to do. The policy of the Plastik Group is to revalue all properties to fair value at each year end, I see. And at the end of the current year, the increase in Plastik's property has already been recorded. Who's Plastik? This Plastik, of course, is the parent. And that figure is the 1,500 of which we just spoke. However, a further increase of 600 to the value of subtract. Okay, so that's not Plastik, that's a subsidiary. That's a different matter altogether, and all this has to do with the subsidiary. So what the examiner is saying is, I know everyone's good at subsidiary accounting, but occasionally, just to shake you up a bit, I'm going to tell you to deal with the parent. So, okay, the parent has been adjusted for. So the credit went to the revaluation reserve as reflected in the OCI, other comprehensive income, and the debit obviously goes to property. And that's how the books balance. All right, and then there's a little mysterious looking loan note from subtract, which is note 2. Inventory, trade receivables, all of them have little stories there. Please be careful. Interesting that the bank balance for the subsidiary is positive, you see, whereas the bank balance for the parent is obviously overdrawn. You can't net them off, you've got to keep them separate, because obviously one could be with one bank, another one could be the HSBC, whatever. So they can't, banks are rivals, they're not going to sort out each other's overdrafts. So you have to keep them separate. The examiner is tempting you to net them off. But that's a fundamental point we covered, F3, the lower level. So if you've got exempted from F3, I'm teaching as if you haven't done F3, all the basics as well, such as that point. Okay, so that's why I'm going to take a few extra minutes over these questions. The loan note I'm going to have to think about in a second. What else is there? The equity shares of $1, lovely. Revaluation surplus, which was something explained earlier. Revaluation, the loan notes, that's fine. And I would say that these loan notes, this one here, can be cancelled against this 1,000 over here. In other words, the subsidiary raised the loan notes and the parent invested in it, as I'm about to show you. Otherwise, the rest of that SFP looks pretty easy. Maybe I'll just deal with point 1 before I come to point 2. I feel we're making some progress. So let's see. Point 1 on the next page. At the date of acquisition, the fair value of subtracts assets and liabilities were equal to the carrying amount, with the exception of a property which had a fair value of 4 million. It's a fair value adjustment, basically, above its carrying amount. And the depreciation is given as 100, so you don't have to do any 9 months or anything like that. So that's really friendly of the examiner. Okay, so let's pop that onto our page if you want to. Some people can hold it in their heads and just write it out in the exam, but I tend to write little bits and pieces down to give myself a chance if I was a student. So let's say page 5 or so. Plastik workings continued, thousands. I have that discipline, you see. I always put in the name of the question or the number of the question on top of the dollar sign. Looks a little bit smarter. Fair value adjustment to S's PPTY property. The first little half mark or whatever is for recognizing the 4,000 is at acquisition, and the post-acquisition depreciation is given as is 100. That's given. So that's one challenge. The next challenge, of course, is there's another 600 for S in the post-acquisition period, after acquisition. Fair value adjustment. Go have a read of that. And then it says the parent also, P, has a 1,500 fair value adjustment, increase in value, already in OCI and revaluation reserve of parent. So what the examiner is saying, which of those items affects goodwill? And my answer is this. This is the only thing that affects goodwill. Why? Post-acquisition can't affect goodwill, it's too late. Post-acquisition revaluation can't affect goodwill, that's too late as well. And of course, parent 1,500 is the wrong company, nothing to do with goodwill. So out of 1, 2, 3, 4 figures he's given you, he's saying to you, think about it, which one or which ones affect goodwill? And the answer is, if I have enough discernment, if I'm prepared well enough, and pick up one of those 4 and put that into goodwill. Many weak students put everything into goodwill, and that mustn't be you. All right, let's move into this intercompany loan note story. He's very fond of this as well. So there's an intercompany loan note. $1,000 to be cancelled. You don't have to write that in the exam, but I'm going to in class. If you write fast, you might be able to fit it in. Now, the big deal is this. Let me see if I can read this with you. Again, this has come up something like 20 times, 25, probably 40 times, something like that in my experience. So, will it come up this time? Why not? So this is okay, that's okay. Point 2, at the end of the year, is that the last day of the year, is it? Last day of the year. So it pays to have the year written out somewhere, so you're sensitive as to what is the start of the year, the end of the year, etc. Yes, that's the last day of the year. So let's read this carefully. Plastik, who's Plastik? You, parent, accepted a 1 million loan note piece of paper from Subtract. You see, the 1 million. So what that means is something like this. If I can just once more make myself get bigger on the screen so it's easier for me to explain. I've got this little piece of paper I prepared earlier at home. There's a loan note, you see, which I, the subsidiary, has raised in my books. I'm a bit short of cash, you see. I think I was overdrawn, was I? And so was I overdrawn? No, actually a little bit short of cash anyway. For whatever reason, maybe I was overdrawn before this happened. So what's happened is, because I'm a bit short of cash, I raise this piece of paper in the subsidiary. I hand over a piece of paper with a few legal stamps on it. Okay, a thick piece of paper worth of just a few pounds. I hand this over to you, and you give me $1 million. So you give me this out of your pocket. The big thing for the student to realize is this million that you're giving me is nothing to do with the purchase consideration of buying my company. It's simply to help out the subsidiary. Now, this is where you need to know a little bit of cash flow accounting interpretation. What I'd like you to do, please, is just look at the question, and you can see there that the bank balance of the subsidiary is 300 positive after the 1,000 has come in. So would you agree, before the 1,000 came in, I was overdrawn. So to help me out, you've given me this 1,000, this million. So that's what loan note means. You simply cancel it, okay? So let me make that my last little exercise before we have a break. So if I can put the solution to that point on the screen, we then have a 5-minute break and come back and finish off. So that's the cancellation. Okay, so I'm going to write here, exam, this is not part of the purchase consideration. Okay, it's not part of the purchase. If it is, the examiner will say the loan note was raised by the parent. Okay, so I'm just going to say loan note is not raised in parents' books, in parents' records, or just parent is good enough, I suppose. It's not raised in the parent, it's raised by the subsidiary. Okay, so I better give you a little break at that point, so we'll come back in 5 minutes and finish off this question. All right, so in 5 minutes we'll restart. Thank you. So sorry. Welcome back. Fatih, can you repeat the finance point? I missed it. My apologies. I will do it again. Absolutely no problem. The finance cost point. Okay. Let's go back, give it a go. Finance cost, where is that? We've got our group structure organized. We've got our share exchange. The deferred consideration. Quite simply, the 1980 multiplied by the 0.9091 gives us 1800. And the difference between the 1980 and the 1800, of course, is the finance cost. Okay, just like in the previous question. So that's your finance cost. Of course, we will explain it again when we put it into the P&L. So we'll have a chance of look at it again. Okay, so I hope that's all right. So where are we? The fair value adjustments, the intercompany loan. So that's under control. And so we're now moving into the last couple of adjustments. So that's under control. Sales from plastic to subtract, so parent sold. Throughout the year ended had consistently been 300 per month. Be careful. Not 300 per annum or anything like that. It's per month. You've got to be a little bit careful with that. Plastic made a markup on cost of 25% on all these sales, but 600 is still in inventory. So you take a 600 and you multiply, of course, by 25 over 125, and that gives you a figure of 120. But you never take a time allocation of that, 9, 12, anything like that, because it's all post-acquisition. Okay, so that's the figure that's in stock in the post-acquisition period. So that's quite an easy one, though to convince the marker, I've got to write something down, I suppose, and to enable me to finish the question. So let's move on in our answer guide that we are trying to compile. Intercompany sales. So parent sold, important to realize who sold. Parent P sold to subsidiary S, and so the NCI is unaffected. Of course, I'll do some MCQs where the subsidiary sells, so we try to cover both styles. What else? It's 300 per month multiplied by 9 months post-acquisition, so 2,700 is the intercompany sale and purchases to be cancelled. And needless to say, but I better say, 25 over 125 multiplied by 600 unrealized, unsold in inventory gives us a PUP of 120. Okay, so the more questions you do from the revision kit, you'll see different permutations, different twists and turns. But that one is quite straightforward. Now, my next worry, as we begin to get some serious marks here, Plastic had a trade receivable balance. This is more like F3, the lower level. But if you've been exempted from F3, this is where I need to step in and help you out. Plastic had a trade receivable. So the parent had a trade receivable balance owing from subtract of 1.2 million at that date. Okay, so be careful. Trade receivables, of course, are debits. Occasionally you have to do debits and credits, the language of accountancy, you have to use it. So in the parent's books, there's a debit, a receivable of 1.2 million at the end of the year. This deferred to the equivalent trade payable of subtract due to a payment by subtract of 400. So I suppose one could say that the trade receivable, okay, the trade receivable must be the difference. So I'm going to say, therefore, the trade payable, I should say, or credit in S looks to be a 800,000 or 0.8 million. So that's your trade payables, because the difference seems to be what they've sent. Did not clear Plastik's bank account until after the year end. So I suppose you could call this cash in transit. It's on its way. Hasn't quite made it for whatever reason, got lost in the post. Okay, Plastik's policy for cash timing differences is to adjust the parent's financial statements. Just follow whatever it says. Okay, so how do I first of all do my accounting, and then how do I set it all up in the balance sheet? That's what I need to show you. So there's a bit of a challenge there. The examiner's told you how to do it, and you must follow the company's policy. So, intercompany receivable and payable, debit, credit. Debit's usually a bit to the left, credit a bit to the right, the way the examiner does it. We have to debit to cancel trade payables in S's subsidiaries books. And that's 800. There is a need to debit your cash in transit, and the question is saying you must reduce from parent's overdraft. Reduce from P's overdraft, because once that money arrives, the overdraft will go down. Excuse me, specific instructions from this in this question how to deal with it. It's not a free-for-all. To cancel, you must credit trade receivables in P's books. And that figure, of course, is 1,200. The way I do it, to tell you the truth, is I look at this as the difference between these two. Maybe I'll just do my arrow slightly differently, sorry. Maybe a little bit easier this way. What I could say is, because these two are given, the difference between these two is that thing. Or if they give you the 800 and the 1200, the difference is the cash in transit. Okay, that's how I used to do it even as a student myself all those years ago. It never fails, because your debits now equal your credits. Okay, just one way of doing it. All right, so that's quite a clever point as well. Otherwise, I think we're quite close to our net assets list. Let's double check. So that's under control. Plastik's policy is to value non-controlling. We can tick that off or put a cross beside it, because we've got to go back and pick up the correct figure. We've been given some numbers on the previous page. The figure, we're going to pick that up in due course. Recent adverse publicity, bad news. Concerning one of the major product lines, the goodwill which arose on the acquisition of Subtract have been impaired by 500,000. Goodwill impairment should be treated as an admin expense. Okay, so put a cross besides that. Like recently we had some problem with Volkswagen's cars with emission control, some problem there with falsification of something or other. So, their goodwill goes down. That guy, if anyone wants to buy that company, they'll knock off a little bit of value, something like that. One of the products, problem, major product line. Assume, except where indicated otherwise, that all items accrue evenly. Good, good, good. That's how we always do it anyway. So the question suddenly has come to an end. So what I need to do, I'm going to now pick up the net assets list, okay? So here we are. Maybe I'll start another page. Give myself plenty of room, around about page number 6. So this is where the heart beats for this topic, the net assets list. Plastic, workings continued. So we need to do the net assets at fair value of subsidiary S at, and here we have all our thousands, etc. And we can have two dates. Acquisition, always leave a couple of inches of space. And so if there's any adjustment, you can squeeze it in between those two columns. It's a nice, decent net assets list. The ordinary share capital of the subsidiary, obviously from the question, like we did before on the previous question, just copy that out. Then comes the inevitable retained earnings problem. The opening is said to be 1,500. Let's go have a look at where that is from the question. So let's keep going back to the question every few seconds to help you to relax that all these numbers are available. The opening is 1,500. Obviously, if the 2,000 is part of the 3,500, the opening must be 1,500. So in my question paper, I could write, therefore, opening at the start must have been 1,500. I'll write it on the screen again. Okay, opening 1,500. How did I get that? Basically, the closing is 3,500 less, for the year, 2,000 was added in. And so if you grab this together, that's how I got the 1,500. That 1,500 is not good enough because I need to add to this 3/12 of the current year's 2,000, this thing here. Profit after tax for the current year. PAT, profit after tax for current year. And so this figure here is 500. And so if you grab hold of all of this, going off to the right is 2,000. So obviously that's an extremely important figure. 85% of students, according to my friends who are markers, who've gone to markers meetings, and the examiner tells us at these conferences, 85% of candidates can't handle that kind of point. It means they're not patient, they're not reading the question. So I'll just run through it again. At the end of the year, the running total is 3,500 of these retained earnings. During the year, 2,000 was added. So at the start of the year, it must have been 1,500. But of course, 3/12 of the 2,000 relates to the pre-acquisition part of the year. So at acquisition, it must have been 2,000. 1,500 plus 500. So this is pre-acquisition. And this, of course, is naturally pre-acquisition. I can do a timeline and all that if you want to, but that just slows us down. You can do one yourself. And then on this side, we'll simply bring in the closing SFB figure, and that gives us 3,500. The well-known 3,500. Okay, so the 2,000 obviously will carry more marks than the 3,500. The 3,500 is just a copy from the question. So get used to that thing in red on the left. However, let's pick up the fair value adjustment, working 1. I believe we had there a 4 million, was it 0.1 early on the second page? And that comes through here as well. Do it systematically. Then you've got your post-acquisition depreciation, which by definition can't be here because it's post, but it can be here, should be here. It's given as 100 in point 1 of the question. Then you have your post-acquisition fair value adjustment to S's property. By definition, it can't be here, but yes, indeed, it's gone up by 6. Because it's on the last day of the year, there can't be any depreciation because it was done on the last day of the year. So quite a searching little collection of adjustments there. Quite a decent question there. And so if you add downwards, the one on the left is 15,000. The one on the left is 15,000. And the one on the right is 17,000, as you can see. Okay, lots and lots of little bits and pieces. And here we can do this mechanically. Dare I use that word. This is used in Goodwill, whereas the difference, 2,000, is used in the NCI and Consolidated Reserves. NCI and Consolidated Reserves, which is what we've got to do, part of what we call the big three. From here on till the end of the question, everything is mechanical. The odd little finance cost unwinding might have to stop and think about. Okay, so we will do that as you ask. So now we're going to do the last bits of the question, which is the same as every question. Okay, so I just make that clear. From here, every question virtually the same. I'll say virtually, because obviously there may be the odd little associate and that kind of thing. But from there onwards, if you can just get the net assets done, you're up there with the very best students in the world. So let's do the big three, which is Goodwill, NCI, Consolidated Reserves. Goodwill, NCI, Consolidated Reserves. And so let's start with Goodwill. One by one, we pick up each of these little pieces. We didn't get a chance to do all three, especially the Consolidated Reserves on the previous small question, but in a massive question like this, 30 marks can accommodate all three, which is why we have to do all three. Now, the actual execution of this is the same as our previous question, Bycomb. So you have your CI, controlling interest. You have your share-for-share exchange. We did a working for the first paragraph. So look at that first paragraph, the working. I believe we had 14,400. We also had in that first paragraph some deferred consideration. And the present value was 1,800. Go check. Therefore, we are now able to bring in the NCI at fair value at acquisition, which is of course 20% because we have 80%, the other people have 20%. The number of shares, the total number of shares a subsidiary has, and therefore the NCI has 1,800 shares. And each of these shares are worth, first paragraph of the question, go check the first paragraph of the question, 250. And so this figure is 4,500. I did that fairly quickly because it was identical to what we did on the previous question. So you don't want to waste your time. And so this is 20.7 less the net assets at fair value at acquisition date, which I believe is up here somewhere. Let's go have a look. There it is on the left-hand side, 15,000. This is so easy. 15,000 take it away, grab your marks, goodwill at acquisition. Less, in this particular question, there was some problem with the products of one of the companies in the group. And so that's given in 6 of the question. Apparently 500 has got to be wiped away. And so after impairment, in the consolidated statement of financial position, the figure there is 5.2, not 5.7. So do be careful if you're doing a multiple choice question. The examiner might say to you, what is goodwill at acquisition? And some people will say 5,200. That's wrong, don't you think? Because the at acquisition is different to at consolidation. Just be mindful of these little tricks he's tried on us in the past. I've been teaching for all these years. All these tricks worry me. So I hope I'm not burdening you with too many worries. But I want you to be prepared for the exam. All right, let's move on to about page 7 or thereabouts. You expect to do 7 or 8 pages for a big exam question of 30 marks. It's quite normal, I think. So let's finish off now. Plastic, workings, continued, thousands. So the goodwill was just the same as the previous question. The NCI, very, very similar, though we're doing this in a more conventional style. From your goodwill at acquisition, but you just write fair value of the NCI at acquisition is worked out as 4,500. Let me just take you back for 1 second. Sorry to take that off the screen. If you look at your goodwill, about the 4th line or so, we have the 4,500. It is that 4,500 we're talking about, okay? So there you are, 4,500. But of course that was 9 months ago. How about the growth since that time? NCI percentage multiplied by post-acquisition reserves, which is of course the change in the net assets. And the change in the net assets, 20% of that 2,000. And if you weren't able to do much studying before the revision course, let me be fair to everyone, take you to this bit here. So at acquisition, it was 15,000, but since acquisition, it's grown by 2,000. That growth, 20% of that, belongs to the NCI. This is the logic. 2,000. So that it looks like 400. And of course, if there's any impairment, the NCI must bear some of that. Impairment, 20% of 500. That's in the goodwill calculation, if you remember. So that's 100 coming off. And so if you have 4,500 plus basically 300, 4,800 is in the CSFP. Quite different, the NCI, to the way the P&L is done. Okay, so better just be careful and say, this is for the CSFP, not CS profit and loss. The P&L is different. Yes, the P&L comes out from that big scheduler workings. So I was looking to see where any questions coming up. And so our last bash is our consolidated retained earnings. or reserves. I think we've said thousands upstairs. So what is the consolidated group reserves? It must be the parent's own reserves at the end of the year, plus what the parent created by controlling the subsidiary after acquisition, plus minus any adjustments. That's basically it. So let's bring those into play. Parent P's own reserves now 6,300. Let's go have a look. Parents' own reserves now, there we are, 6,300. So that's the first bit. Everything has logic. You just have to build up the logic by doing a few questions for practice, getting a bit more confident. Less the pup because the parent sold. Obviously, on the previous question, we didn't have to bother with the consolidated reserves, but here we can't get away from it. You have to do it. So the pup, if you remember, in our workings, what working number was that? Something like working 3, I believe. If you want to put in these little cross references, it looks nice. What else? Can I just say, if subsold, not shown here, but as a deduction in net assets list at CSFP date, the list on the column on the right. Okay, so what if? I like to teach on a what if basis, not just doing every question, the question we're doing, but to think of what else the examiner might do to you. So let me take a few extra minutes saying that. Now comes that lovely point, the unwinding. So I'm going to say unwinding of the discount for 9 months only. And that's 135. 9 months unwinding of the discount. Let's see if I can find it in my workings somewhere. The fair value adjustment is there. Intercompany loan note, intercompany sales, receivables, payables, all lovely. The 9 months, let's see if I can find that with in the goodwill calculation. The goodwill deferred consideration present value was 1,800. So see if we can turn that up for you. Group structure, share exchange, deferred consideration. There we are. Sorry. Gives you a chance to just relax and look at that. 135. Okay, where are we? Let's see if I can finish off now. NCI under control. The consolidated retained earnings, don't forget the 135. The reason why it's in brackets is the parent has to pay it. It's like interest on the present value discounted. All right, so that's your parent taken care of. Okay, in a sense, all of this belongs to the parent. So having dealt with the parent, we're now turning our attention to the subsidiary. So I'm going to say add the group share of subsidiaries post-acquisition reserves. And that, of course, is 80% multiplied by the 2,000 net assets change. Go check the net assets list And you'll see there 2,000. So that 1,600 comes into play here. And of course, we mustn't forget the controlling interest impairment. And that, of course, is 80% multiplied by the 500, which we've used in the main goodwill, as well as in the NCI. And so this is 400. And so tapping that into a calculator, the consolidated reserves requires a few extra minutes in the exam. Okay, so always plan that. Of course, it'll be rewarded with lots and lots of marks. 7245 is in the CSFP. And obviously, because we are heavily into CSFP, there's one there. If you go back to the NCI, that's the CSFP. And if you keep going back to the goodwill, for example, if I can turn to the goodwill, right at the end of the goodwill, there's a CSFP there as well, you see. So because you're heavily into CSFP, it seems like the most obvious thing to do next. If you do the P&L, you lose your focus, I believe. So I always say to my students, do the CSFP since you are partway there already. Okay, therefore in exam, do this next. All right, so let's go off and see if we can balance this balance sheet and then throw the rest of our time into getting the P&L organized. So make a start on the balance sheet if you would, please. If I just give you a couple of seconds start, what would you put down in your balance sheet, your SFP, please? Here we are. Let me catch up with you. All thousands, so we've got our non-current assets. Property, plant and equipment is 18,700 for the parent. The subsidiary is all of the 13,900, not just 80% of it. You know, stuff like that, I hope. Plus 4,000, the fair value adjustment. Next line, perhaps. Minus 100 depreciation, plus 600, also for the subsidiary. And the parents has already been reflected, apparently. So this figure already reflects the revaluation in the OCI, says the question. So don't bring it in again, it won't balance. All right, so that's that. What else do we have? We have the investment, it's all cancelled. All the investments is cancelled, including the intercompany loan note, etc. Investment cancelled, including the loan note. I'll just say that. And so you have your goodwill, which came from a massive working, a figure of 5,200. Adding them up, 42,300. Then you have your current assets, which is your inventory, which of course is 4,300 for the parent, 1,200 for the sub, minus the famous PUP. So it doesn't matter where you show the PUP, whether you deduct it like that or deduct it a bit to the left. 5,380, it comes off the group running total. 5,380, okay. Then what? Trade receivable is 4,700 plus 2,500. minus 1200 working for that intercompany cancellation thing we did, and that gives us 6,000. So you go check all those workings if you wish. Then you've got your bank balance, which is said to be 300 of the subsidiary. So this is 11,680, which when added to the 42.3 is 53.980. And that's your total assets. Usually the top half of the balance sheet, the SFB, is a little bit quicker than the second half. The second half is more dangerous, let's say. Carry a little bit more marks. Equity and liabilities. The ordinary share capital has 10,000 in the original. Let me just show you. Really, really important point coming up. Are you ready? This 10,000 is the original, you see. This is the original figure. But of course, that 10,000 did not include none of the consideration. See that? None of the consideration has been recorded in other words, the share for share exchange. Okay, so that's not yet recorded. Okay, so the new shares issued are not yet recorded. Okay, so they have to come in. So there you are. I'm going to bring into play the original plus 4,800 working new issue by P to buy S, to capture S. So it's not 10,000 but 14,800. And of course the share premium must be kept separate, also known as other components of the equity, and that of course was 9,600, all from the share for share exchange, new issue. There was nothing in the original. The revaluation reserve from the original question of 2,000 I need to bring into play, so I'll just bring that in. From the original question, because that includes the revaluation of the parent's property. Then you have your consolidated retained earnings, that massive reserves working we did, that came to 7,245. You see? Then you have your NCIs, which is 4,800. And so it goes on and on and on. Never-ending questions these are. We'll be doing our best in class to explain everything, so a little bit slow, hope you don't mind, trying to explain. And so we have the 10% loan note of parent company. The subsidiary, of course, was cancelled. Of parent, i.e. issued by the parent, not the subsidiary. Okay. All right, so that's your 2,500. And then you have your current liabilities. So it's not about balancing these things. If you can, that's wonderful. It's just about getting it half right and you'll pass. That's easily achieved. Here comes your deferred consideration, because it's 1 day into the new year it's owed, so that day hasn't happened yet. Present value plus the unwinding. In fact, it's 3 months into the new year, I should say. So the unwinding, that comes to 1935 because of the unwinding. The unwinding was on the workings, remember that? What else do we have? The trade payables is 3,400 plus 3,650. Straight from the question, you can see that. 3,000 plus 3,600. My mistake. 00 sounds better. Then what? Minus the 800 intercompany working 4, I believe. And so that comes to 6,200. The bank overdraft, I've got to be a little bit careful with, because says question, the 1,700 of parent must be reduced by the money coming in, cash on its way, in transit. And so this figure is 1,300. So not only must you keep the overdraft and the subsidiary's positive balance separate, the parent's overdraft is reduced by the money that comes in from the subsidiary. Tricky little point that. But it's all there in the question, you just have to read the instructions. Tax 2,800 plus 800, 3,600. And so this is 13,035. So push yourself to do a few of those homework exercises so you get better and better at these things. One thing the examiner will see, that in these March sittings, these every 3 months type sittings nowadays, there'll be an awful lot of underprepared students, yes, who are nearly there, 45, 46, pretty good marks, but not good enough. So you mustn't fall into that trap saying, well, it's, when you just done the exam in December, some other subject, how can they expect me to reach a standard? Well, you just have to push yourself. Okay, so I'm choosing questions that I feel are representative of what might come up. Do some homework. Okay, I'm at the other end of a line, so any emails you want to fire at me, it's my privilege to help you. I'll be having a little mentoring session with you as well. Total equity and liabilities. And that, of course, balances with the previous, with the upstairs story, as you can see, 53,980. Okay, miles upstairs there. Now, we have a few minutes left. If you don't mind me overrunning slightly, we can do the discussion part tomorrow. I'd like to just get this P&L done, if that's okay with you. We've done half the P&L on the previous question anyway, so now it becomes a question of just using those skills. So here's your P&L, the splocky. The revenue, where's my question? Right, I've got my question in front of me. The revenue of the parent is 62,600, so I'm going to just copy that out. The subsidiary, 9/12 of the figure given, 30,000 post-acquisition, 22.5. Lovely. The intercompany sale, 2,700 from working 3. Was it 9 months of 300 or some figure like that? Please check. And so if you add across, this is 82,400. Dead easy. Less cost of sales. 45,800 for the parent. Subsidiary 24,912. 18,500. Everything you put down, try to explain what you've done and the examiner will favor you. Notice these are the same, see? Like we said before. Okay, cost of sales more or less under control. Mustn't forget our old friend the pup, which was working 3, I believe, in this question. 120. Parents sold, parents column. Subsidiary sells, subsidiaries column. So parents sold to the subsidiary, so parents column. Depreciation, I think it was given in point 1. Subs asset, so subs column. Whose asset? That's the test. And as you grab these together, 1, 2, 3, 4, 5, quite common with our examiner to have loads of items there. 61,320. Huge marks if you can get that figure right. And using a ruler, make it look professional. Don't just do a freehand line. It looks so scruffy. Use a ruler. Even a 6-inch ruler should, I tend to use a foot long, 12-inch, but 6 inches should be fine. Gross profit, whenever you draw a line, add downwards. So you have 16,680. This one is 4,400. The adjustments have all disappeared. And this is 21,080. See that? That's going to carry a few marks, the famous gross profit. And so we march on, fighting the clock as you would do in the exam. Distribution, this is a bit of a gift, isn't it? 2,000, lovely. 9/12 post-stack of 1,200. Which is 900, I suppose. Switching it out of there. Adding across to the right. Lovely. Then comes our admin. 3,500. 9/12 of 1,800. Which is 1350. I won't add it up just yet because I've got my goodwill impairment, all that kind of thing. Remember, the goodwill is automatically after acquisition. You can't have goodwill before acquisition, and that's 500 given. So if you grab hold of these little bits, I believe that is 5350. Dare I say it, absolutely mechanical once you've done a couple of questions. Then comes the famous finance cost, which is in the question, parent, 200. I can't see any subsidiary finance cost, good. But now we have the rather fancy unwinding. Meant only for good students. 135. Put that into the parents column because the parent has to pay that interest, in a sense, to the subsidiary. So if you grab hold of all of these, this figure is 335. And so we add these up. So let me add it up and then I'll just go back and confirm once again what I did up there. Profit before tax, adding each column up separately. 16,680 minus, and minus again. 4 deductions, 10,845. The next one I believe is 1650. The adjustments I'm confident has disappeared. And this last figure here looks like, using a calculator of course, careful, 12,495. Try to add each column up separately and then right at the end add across. Don't do that too soon. And I'm just going to invest a couple of extra minutes re-explaining what we did up here. comes at the end of a session. It's hard to keep up, obviously, if you're getting tired, especially if you've been working all day. I was a part-time student myself, so I sympathize when people say they're tired after a day's work. Absolutely. Depends on which country you're in, of course. So the revenue, lovely. The revenue is straight from the question, the parent. The subsidiary is 9/12. Don't take 80% of it. Do the 80% right at the end, or take away the NCI right at the end. That's how it's done. The cost of sales, like we saw before, don't forget the PUP, who sold. Subsidiary sales goes to subsidiaries column. Parent sales goes to parents column. Depreciation, if it's a subsidiary's asset, goes to subsidiaries column. Then you grab hold of all of that, 61,320 on the right is the cost of sales, grand total. Distribution, bit of a gift. Admin, a bit of a gift. Goodwill impairment, nothing to it. Just put that into the subsidiaries column because thereby the NCI will suffer. Finance cost, don't forget the unwinding. But having done the previous question, you get used to this examiner. He loves all those tricky little points trying to scare you. Keep your nerve. If that's before tax, let's take away tax. This is not a tax paper, though tomorrow when I do my published accounts, there are one or two little tricks in deferred tax, but still not as bad, nowhere near as bad as real F6 and P6 and those serious papers. This is a bit of a gift, actually. As far as the parent is concerned, the tax looks to be 3,100. The subsidiaries is the famous 9/12 of 1,000, which is obviously 750. Left to right, 3,850. So sounds like parent comes from the question, subsidiary is 9/12. And that's the staple marks you're getting. Every time you do that, you get something. And then every now and then you stop and think about goodwill, impairment, and PUPs. But otherwise, you're just copying from the question, really. And that's the beauty of these columns I'm using, which is why I selected this method all those years ago. There are other methods around, but this one seems to be quite easy to get marks with. Easy marks, cheap marks. Profit after tax for financial year. And that is 7,745. This is 900. Nothing there. And 86,45. Okay, so profit after tax. We then come across the famous other comprehensive income, and we have the gain on the revaluation of the PPTY property. Now, careful. Parents apparently 1,500 from the question. The subsidiaries, if you check out your working or your net assets list, I'll put in 600 over here. So that's actually given in the question, in point, where is it? Let me see if I can find it for you. This 600, you see, that's given. And that's at the end of the year. It's obviously post-acquisition. So that 600 is given. You've got to show it somewhere. It's post-acquisition, fair value adjustment. That's okay. And so if you add left to right, this looks like 2,000. So that other comprehensive income looks a bit, scary, but it's actually very simple. Just bring in some figures. Obviously, when you're doing your NCI, so you've got to be a little bit careful, as I'll show you. So the total comprehensive income is 7,745 plus 1,500, 9245. This is what, 1500? This is nothing, and this is 10,745. And of course, if that adds up, you are in business. You're up there with a prize winner, almost. Because we haven't done the attributable bit at the end. Attributable to, obviously, the NCI, which must be this thing, bringing it down, 1,500. And if you take your 20% of that, that's 300. That's the easiest NCI method I've ever seen. This particular technique I'm showing you with columns, the NCI is a gift. Yes? Otherwise you need to do lots and lots of little calculations to get the NCI. Then you have your equity holders of the parent. Which is whatever's left, actually. So if this is 10,745, here we are, 745. The difference, 10,445, is what we call equity holders of the parent. There, in the homework, there's a little MCQ from our revision kit, which actually says, do a little bit of that sort of thing, a tiny part of that kind of question. And it simply says, what is the equity holders of the parent? What does that equal? Sometimes it's called owners, equity owners of the parent, 10,445. So you need to first sort out the NCI, and whatever's left goes in there. One thing that you're not asked to do, I'm happy to report, is reconciling the 10,445 with the consolidated reserves. That used to be in our syllabus, but now it's no longer is, and that's good news, as I'm sure you will agree. In other words, you don't have to reconcile that 10,445 with the consolidated retained earnings. Obviously, there are all kinds of little adjustments and revaluations and all that kind of thing, so don't need that. All right, so there we are. The question, we've got a little bit of writing to do, the dilemma assets treatment. How do we deal with that? See if I can just jot down a couple of points so we feel we can walk away from this question. If you don't mind, if you can give me a couple more minutes, please. 5 or 6 minutes more, we should get something going here. So this question right at the end, we've done this, all those marks. It then says plastic, the parent, you see. So have a little read of that, please. Just relax as we're doing this, these little written bits, which are done very badly by students. I want to just give you a chance to think about it first. Plastic is in the process of recording the acquisition of another subsidiary, I see, called Dilemma, and has identified 2 items. I like the name Dilemma because most students would have been in a dilemma. Okay, 2 items when reviewing the fair values of Dilemma's assets. The first item relates to 1 million spent on a new research project. This amount has been correctly charged to profit and loss by Dilemma. Of course, you write off research, don't you? But the directors of Plastic have reliably assessed the fair value of this research to be 1.2. Actually, that should be shown as an intangible asset, as I'll show you. The second item, so there's a first item and a second item, relates to the customers of Dilemma. The directors of Plastic believe Dilemma has a particularly strong list of reputable customers which could be sold. Names, you see. The value of the customer list is said to be 3 million. That's definitely going to come in. So the examiner is saying, state whether and if so at what value the 2 items should be recognized in the consolidated statement of financial position of Plastic on the acquisition of Dilemma. Okay, so don't change the first answer based on this. Let's see if I can write out 3 points with you, because these written bits you must do and traditionally done very badly. So we've got a couple of minutes here to invest, if that's okay with you. Let's see if I can put something down. 3 marks means 3 minutes. 3 points. IFRS 3. The examiner is fond of mentioning all these IFRS numbers. If you can, great. If not, don't worry. Addresses these intangibles. Both identified by Plastik should be recognized as separate, I'm going to underline that, intangible assets on the acquisition of dilemma. Okay, that's 1 mark, perhaps, hopefully. Let's say both the IFRS 3, which covers all this sort of stuff, and the IAS 38, which is on intangible assets. This is on consolidations. IFRS 3 require in-process research in a business combination to be separately recognized at its fair value, provided, fair value, comma, provided this can be reliably measured. And in this case, 1.2 million in this case. In other words, the group's view of the figure, not the individual company. And then finally, just to clinch my 3rd mark, sorry to delay you, the recognition of customer list of the customer list as an intangible asset is a specific example given in the IFRS, illustrative example given in the IFRS. And should be recognized at its fair value of, the question says what figures, I'm going to go for 3 million. For example, when you become an ACCA, I did the ACA exams, which is similar, and I know when I qualified, when you qualify soon, sometimes your name gets onto a list of people who can afford a little bit more maybe, because you're a qualified accountant, ACCA, and so that list of ACCA newly qualifieds gets sold. Won't be done by the ACCA, but somehow people compile that. And it's a bit like a customer list, a potential customer list, okay, which is, it has value. And so that's how you get lots of this junk email and so on. and little things through the letterbox. I used to get loads of them when I first qualified, till I said no to everyone, and then they stopped doing it. But it's something that irritation, but it is in a business sense, of course, it has value. Otherwise, thank you very much. We've done quite a few things there. A small question and a massive question, all the while stopping and saying, what if this comes up? What if that comes up? What if you haven't done the main course? If you're doing this revision for the first time, that kind of thing. When I see you next time, which is tomorrow, I hope to do a few of these MCQs on consolidations, and then we'll spend the rest of our time doing published and standards. Thank you very much.